Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at some information that's gathered on Twitter. I'm going to go over a wide array of stuff: energy, precious metals, uranium, whatever else is on there. I look at everything that's commodity related. The reason I'm sticking more towards commodities is because that's where the value is. And commodities in relationship to stocks and other assets are quite cheap, and they're improving for the better in an uptrend. In the short term, they have pulled back. I'm sure everyone's noticed that has exposure to commodities. But overall, I think that we are in a secular bull market, which is a very long-term bull market, and we're going to have cyclical pullbacks within it, which could last months or even maybe up to a year or so of pullbacks within this big bull market. My strategy has been to remain long, go long, stay long, as long as the ratios are making higher highs, higher lows, and that value has a large runway in front of it. So I think we'll be in this bull market for a while. And here's some information that I've been looking at. I'm sharing it on my Twitter. If you want to add me to Twitter, my name on Twitter is @finding_finance if you want to add me. And I share a lot of information on here. It could be another source of getting information that you guys are interested in if you're a commodity bull. I'm a huge commodity bull, and this downturn, I'm just waiting to see when the buyers step in. I'm being patient here. Almost always, I'm too early to enter. A lot of the times, sometimes I get lucky and I play it well. Sometimes it doesn't work out my way. I hold on and hedge myself with time. I want to play the big move. I'm not trading in and out. I did that last bull market. Again, I didn't have as much experience trading at that time, but it didn't end very well, and I don't want to mess it up. If the returns are going to be very large, I don't want to try timing this stuff. I just want to be in it and ride it. So let's go over the information we've got here. It says, the question has been asked, what is holding the gold price down so well? Here she says time. So this is the CPI is less than the PPI in the US. SPX is less than the precious metals in USD. So here's a chart that she's sharing. And I think it's kind of a cool chart. I've never really looked at the ratio of the CPI divided by the PPI. And so long that the PPI, when this is going down, the producer price index is outperforming the consumer price index, which means that forward expectations of inflation are greater. So it's PPI is kind of leading the CPI numbers to some extent. They're not perfectly correlated, but they are correlated, and they usually lead. And whenever that's leading, it means that we are heading lower. And whenever this is going down, it looks like to me that platinum, silver, and gold follow suit next. So if you were to look at history, this thing rolls over and heads lower. These guys eventually follow with it, which means that gold, silver, and platinum outperform the S&P 500. So when you have a scenario where PPI is greater than the CPI and it's going up at a faster rate, the metals outperform. And we've got that signal where we've fallen with this ratio and the metals have not responded yet. We had this similar movement before, coming before here, and then all the metals fell later. So we'll see what happens here. According to this, we should have a large movement in these ratios where precious metals outperform the S&P 500. Either gold goes up while the S&P 500 goes down, or the precious metals just flat out outperform the S&P 500 on the upside. So we'll see what happens there. One piece of information we've got, note the incredible pain for not understanding the cycle as well. And this is the cycle. This is for uranium. I'm going to go over a couple of these charts that are posted. This is Camco. The time frame is 03, 04, 05, 06, 07, 08, and 09. And you can see some massive returns during that time frame. In 02, and I think we're way back here. We're real early. In this mix, I think we're still in a bear trap that happened in 0102 is when that happened last cycle. But looking at it just past that cycle, 342 all the way to $49.60. And you can and one thing you want to look at when you look at these charts, look at the pattern it is making. We basically come up and it creates this sideways movement for a while, and then you get a peak, and then we get a pullback. This cycle also repeats on shorter time frames and longer time frames. It's a fractal that repeats. A fractal is a pattern that repeats over and over on different time scales. So this fractal does repeat, and I see it all over the place. Looking at this one, the same fractal. This is Denison Mines, very cheap, 25 cents to 16.57 at the total peak. We come on up in this back and forth motion. We go into a consolidation period for about October, about a year, a little over a year in a consolidation period, and then it did a blow-off type movement before heading lower. This one is Energy Fuels, massive move in a very short time frame. This was from 06, 350, all the way to $274. Wow. 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 And this thing was in full launch mode, and to go 140 to 68.50 would have been a very big pullback. And I doubt many people went from 350 to 274. That would have been a very hard holding period with this large pullback from 140 to $68. That would have felt like an eternity and a complete raping to the downside. And this next one is UEX Corporation. This was a much smoother ride, but still volatile. I should say it took longer to do it. 5 cents all the way to 9.30, and it was back and forth, multiple pullbacks. And remember, you're going to have to live through this type of pullbacks if you want to make that money. It's not an easy ride. Looking at some of the other ones we've got, this is uranium. This is the current spot price. So this is the Sprott Uranium ETF. We've moved on up, and we're coming on back. We're right at a point where we've got support coming from the long-term support coming up, and then the shorter-term support coming down. And we're right there, and we'll see if this support line holds. I'm kind of just sitting there waiting. Now, remember about the fractals I talked about. This fractal here is the same fractal as this fractal is here. Now, if you look at the pullback, this pullback is roughly the same as what we have here. So it is very similar, and it's almost interesting because you could probably measure this pullback and get a percent ratio and almost try to get that ratio coming back. It looks very close to being about where we're going to end. And hopefully we get a nice big move higher. But again, I don't want to get in the short-term prediction game. I don't want people being focused on me making a right or wrong call on a short-term move, which is 60% right, 40% wrong. Focus on the big picture, focus on your strategies, focus on that stuff. And I think, and I'm not saying this isn't advice by any means, I focus on my strategies. I focus on the strategies that I'm trying to deploy and stay invested and positioned for the big move. And hopefully this in the short term is the bottom here, hopefully. Looking at this, key bullish long-term argument for all shipping and shipbuilding capacity reduced by 40% since the peak. This is the peak, and then we've got this large decline in shipbuilding. That'll work its way through the system at some point. Soaring prices of key materials and wind turbines, solar panels, and batteries wipe out years of cost declines. And this is what I was talking about. We had a decline in commodities, which correlated with the decline in all of these renewable energies. Once the commodity prices start to go vertical and the energy prices start to go vertical, so will these prices. They will start to go up. And that's exactly what we're seeing in all of these renewables. So this is very interesting. He's got U.S. total public debt momentum exploding, and the 10-year yields breaking out of a 40-year descending channel. And I've talked about the yields in the 40-year trend line. So here's the channel that he's got put in here. We've got the breakout in the circle here, and they may pull back to do a retest and then move higher. This down here is the eight-year rate of change for total public debt. And this public debt is now rising. Usually a rising public debt is an inflationary period, usually. And that's what he's got. He's got the correlation of the rising interest rates and then the rising total public debt, and that they're correlated. And the rising rates are a reaction to that increase in debt. Increase in debt is inflation, more or less. It says, what happens when you stop investing in an energy source because it's not ESG friendly? It goes vertical, I guess, and especially if you have problems in your energy resource. So massive move in coal prices. And again, this has moved already. I'd rather take my bets in natural gas in America. That hasn't moved yet. It says Biden says his team is meeting oil company CEOs this week. Oil firm CEOs to be asked to justify their profits. I'm sorry, but this person's a moron. In a free market, you're asking the people to justify their profits in which he's the same person to tell them to stop drilling and put all these restrictions on them. The guy is absolutely out of his mind. Okay, whatever. And they did this back in the last 2008 bull market. They brought in all the oil executives and were like, how come you're not pumping more? How come you're making so much money? And all they would ask is, oil's traded on the free market, and we don't even pump that much oil in relationship to all the other people in the world who massively pump oil, like Saudi Arabia and all these others. Here is, for reference, energy stocks outperformed despite oil demand drops in 74, 75, and 1980. And oil demand is currently still rising. So this here are the rare occurrences where oil demand fell year over year. 2020, 80, 81, 82, 74, 09, 08, 75, 83, and 93. I don't think we're going to get in that scenario. I think oil demand will continue to go up. And it says, although demand falls on average of 1.6 year over year, many of these years relate to the 79 oil shock. Overall, most minor global recessions have never caused a drop in oil demand year over year. It's interesting. We've got this guy. This is the SPR releases backfire often. So they release from SPR, backfire, and they're backfiring. They don't actually work. So it's basically a chart saying that the Strategic Petroleum Reserve releases don't work in holding the price down. This is what it says. Here's what did well last time there was stagflation from 71 to 81. Energy equities did the best. REITs did the second best, and all these other ones didn't do very well. Treasuries, the 10-year did pretty poorly. Coming on down, it says, what does this mean for energy stocks after the worst week since March 2020? At $100 West Texas Intermediate, we model the average Canadian energy company is able to privatize with just 3.4 years of free cash flow. They can buy back all their shares, is what he's saying. And trades at 2.4x enterprise value to cash flow versus 15 years of stay flat inventory equals 13 years of 29% returns for free. And then he's got some companies down here. I just want to make one comment. CDEV, the company that's one of my largest holdings, is one of the cheapest companies in terms of 2023 enterprise value to cash flow. And I own a lot of these on the left-hand side. There's Crew Energy, CPE, which is Callum Petroleum, CDEV, Crescent Point Energy. There's a bunch that we have on this left-hand side over here. Athabasca Oil, all very nice looking, cheap companies. Now, the Exxon CEO warns of oil markets may be tight for up to 5 years. He says, why do we believe we are in a multi-year bull market for oil? It's cycle time. 4 to 6 years for even the best, like Saudi Arabia, to add meaningful capacity. And the global super majors still are not yet in the spending mindset. Very relevant to trading multiples. Yes, I think we're going to go up quite a bit. And here's Eric again, Economics 101. Prices dictated not just by demand, but supply. OPEC is out of spare capacity in 2 months. U.S. shale hypergrowth is over, and super majors flat till 2030. Supply challenges, in my opinion, to overwhelm any moderation in demand growth equals inventories to continue to fall. And FEAR, fear, is the acronym for false evidence that appears real. And coming in the oil market, the thoughts on the recent pullback. It says, what has changed fundamental-wise? Not much, nada, zilch. Nothing's changed fundamental-wise. It says, oil has long since been pricing in a global recession. which is why we have been confined to the 105, 120 barrel range rather than pricing at $150 a barrel. The financial paper market is plunging, but the physical market remains undeniably strong. That is what we see, and it's a physical inflection point. It says there are minimal major signs of material demand destruction despite elevated crude price. The fundamentals, false evidence and appears real, is out there. We've got, if oil demand was weakening, it would show up in two places: time spreads and inventory levels. Neither are showing any signs of weakness. Is this vicious sell-off solely based on fear? And we don't see any relaxation in the Brent 1-2 time spreads, and we still see a decline in inventories. Fundamentally, everything's intact. I posted a couple of these up. It says patience. It says where the patient make money from the impatient. That is how you make money, by being patient. We've got here, the stock market is filled with individuals who know the price of everything, but the value of nothing. If you know the value of things, you don't really care about the price as much. You only focus on price for your entry points to get the best price possible. But knowing the value means that you can hold on. I use ratios for finding my value. Obviously, I got a couple of things up there. Warren Buffett spends big as stock market sells off, loads up on energy stocks as inflation soars. So he's loading up. Worried about the impact of a recession on oil demand, inventories. Energy Aspects is modeling recession in US and Europe in 23 and still has inventories falling by 0.4 million barrels per day next year. Challenges to supply growth to outweigh any demand weakness. This is a supply-driven problem, not demand. Here's something that's pretty crazy. I listened to this. I think everyone should listen to this. It's on my Twitter here. He says, to get the same amount of energy from solar wind that we now get from fossil fuels, we're going to have to massively increase mining by more than 1,000%. And that's impossible, guys. There's no way. Oil and natural gas cannot go away because we can't replace it with these solutions that they have. Maybe you could make it go away with a bunch of nuclear, but I just don't see that going into the plans yet. So I think oil, natural gas, coal, all these energy, fossil fuels, I should say, should do well for a very long time. He says the ESG bubble is about to burst. It's now clear that the ESG, which is environmental social governance investing, including solar panels, was an elaborate scam. Governments are cracking down. German prosecutors just raided ESG, Deutsche Bank, and all these others for the scams. Investors are fleeing the ESG movement, according to this article. This is cool. Nuclear power emits 4 times less carbon than solar. This is your nuclear produces the carbon pollution from solar farms, geothermal, hydropower, and nuclear. It is the best solution in terms of basically in almost any metric. Safety, carbon, in terms of energy returns, in terms of mineral intensity, it goes on and on and on and on. Nuclear power produces 300 times less waste than solar. Solar has a butt ton of waste. Nuclear is the only energy source that prevents waste from going into the environment. The only one. All the nuclear fuel ever generated in the US safely contained and can fit on a single football field stacked less than 10 yards high. Solar, not so much. Produce that waste. And I'll stop it there, guys. That's what I've got for an update for, at least from Twitter. And I think there's a lot of good information. The fundamentals are all still intact. People are selling off in the paper markets. What do? I don't do anything until I see some buying pressure come back in. So the fundamentals are good. This is where the opportunity lies. If the fundamentals are still good, but the price goes down, well, there's your opportunity. Now we just have to wait and see when the price basically starts to bottom out and turn back up. And that can happen very quickly. There's multiple strategies that you can deploy. You can look at, cost averaging in, if that's a strategy where you basically buy it in tranches over time. That is something that I do. I don't try to time the necessary bottom. If I think we're getting close, I start just tranching in. I call it sprinkling in. Get a little bit of sprinkling in there, and then I hold on. And I know that some of these pullbacks can be quite vicious. Some of them have have happened in a very short time frame or time span. But the fundamentals are still good. And that's when you just hold on. The ratios are still good too, signaling that some of these commodities are still incredibly cheap. That's the value. That is what you have to chase, is the value, not the price, the value. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys want to. The Platinum membership's the membership that I would sign up for. We had a question and answer session coming Saturday, Mountain Standard Time, 7 a.m. and 5 p.m. I got 2 sessions, hour and a half long each. And you can join either one. So if you guys want to join that, ask some questions. Perfect. Hopefully I grab 2 times that most people can join and ask questions. Or you can attend both. That's fine too. Whatever. But we'll catch you next time. This is Finding Value.